Imagine turning just $1,000 into $100,000 or even more by following the exact strategies Warren Buffett has used to become one of the richest men in the world. And here's the secret most people don't know. Buffett didn't need luck, insider tips, or complicated formulas. He followed simple, repeatable rules that anyone, even beginners, can use starting today. In this video, I'm going to show you 5 exact steps that will change the way you think about money forever. You'll see real examples, real numbers, and even a stock Buffett bought over 50 years ago that multiplied dozens of times. If you watch till the end, you'll walk away with a clear, bulletproof plan to start building real wealth. And I'll show you how to avoid the mistakes that cost most people their money. Before we dive in, hit subscribe if you want proven investing wisdom that actually works. This channel will show you how to grow your money the Buffett way, step by step. Now, let's uncover Buffett's 5-step beginner investing plan, and I promise by the end, you'll see investing in a completely new light. Warren Buffett was born in 1930 in Omaha. By age 11, he bought his first stock. As a teenager, he sold newspapers and pinball machines, reinvesting every penny he earned. He studied under Benjamin Graham at Columbia University and learned value investing fundamentals. By the mid-1950s, he started the Buffett Partnerships, and by 1962, he became a millionaire. In 1965, he took over Berkshire Hathaway and turned it into the investment vehicle we know today. Buffett views investing as owning a piece of a business, not gambling with stock tickers. He says, rule number 1, never lose money. Rule number 2, never forget rule number 1. His favorite holding period is forever. He says, only buy something you would be perfectly happy to hold if the market shut down for 10 years. He practices what he calls a circle of competence. Know what you understand and don't stray into areas you don't. Buffett believes you don't need to be a genius. His approach is not beyond anybody's competence. Patience is not optional. The market is designed to transfer money from the active to the patient. Avoid emotional decisions. Don't chase fads or panic sell. Let's start with the first step you can take today to follow Buffett's approach. The first step is to start early and let compounding work. Buffett says, the best time to invest was yesterday. The second best time is today. Compounding is the 8th wonder of the world. If you invest a small amount every month, over decades it can grow into a significant sum. The earlier you start, the more compounding works in your favor. Berkshire Hathaway has delivered nearly 20% annual returns since 1965, far above average stock market returns. Earnings generate more earnings. Dividends reinvested. As your principal grows, your returns scale. Avoid withdrawals. Even with just $50 or $100, open an investment account today. Automate monthly contributions. Reinvest dividends. Let time be your engine. Next, let's talk about investing in what you understand. Buffett's principle is simple. Never invest in a business you cannot understand. Know your circle of competence and stick within it. If you understand retail, health, or technology, pick a few sectors you can analyze. Avoid speculative areas you don't understand. Don't follow stock tips blindly. Investigate the business. How do they make money? What are the key risks? What drives growth? A classic example is Coca-Cola. Buffett bought it in the late 1980s. It was a simple business. People drink soda. Strong brand, durable moat. He understood it and held it for decades. Your action step is to list 3 industries you understand. For each, pick one company and write down how they generate revenue, their key risks, and growth drivers. Never invest in businesses you cannot explain in a few sentences. The third step is thinking long-term. Buffett says, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Daily price swings and headlines will distract you, but fundamentals matter in the long run. Buffett describes the market as a voting machine in the short run, but a weighing machine in the long run. He also says the stock market is designed to transfer money from the active to the patient. When markets drop, don't panic sell. Be greedy when others are fearful. During the 2008 financial crisis, Buffett invested $5 billion into Goldman Sachs when others were desperate. Adopt the 10-year mindset. Before buying, ask yourself, will this business still be strong in 10 years? Ignore short-term noise. If a great business is temporarily depressed, consider adding, not selling. The fourth step is value investing with margin of safety, keeping costs low and avoiding debt. Buffett looks for businesses whose intrinsic value exceeds the market price. He worries about overpaying. A too high purchase price can undo a decade of favorable business developments. Buy with a margin of safety and keep costs low. High fees erode returns. That is why Buffett recommends low-cost index funds for most investors. Avoid debt. Buffett warns against credit card debt and unnecessary borrowing. Keep some cash to seize opportunities. An early example is the Sanborn Map Company. In the late 1950s, the market undervalued the company's assets. Buffett acquired a large stake and earned 50% in 2 years. That is classic value investing. Buy undervalued assets and exercise patience. The fifth step is continuous learning, patience, and humility. Buffett spends hours reading every day, annual reports, books, newspapers. He says, "The more you learn, the more you earn." He studies business models, accounting, and management quality. He knows he is not perfect and avoids overly complex strategies. Most successful investing is about temperament, not IQ. Avoid overtrading. Over decades, consistency compounds. Every week, read one business or finance article, an annual report, or a Buffett letter. Keep a learning journal. Resist impulsive trades. Let's look at real Buffett investments to see these steps in action. Coca-Cola, bought in 1988 after a market crash. Buffett believed in the brand and durable consumer demand. He held it for decades, collected dividends and watched it grow. American Express, invested during a scandal. The market feared exposure, but the business recovered. Buffett bought when others were fearful and earned massive returns. Apple, invested because Apple became a consumer brand with recurring revenue. Predictable profits and a strong ecosystem made it a great long-term investment. During the 2008 financial crisis, Buffett invested in Goldman Sachs and other banks when everyone else panicked. Staying calm, holding cash, and investing in downturns produced big returns. Sanborn Maps. Early in his career, Buffett found a company whose market value was less than its assets. He bought in and earned 50% in 2 years. Buffett looks for businesses with durable competitive advantages, predictable earnings, strong brands, and manageable debt. He wants at least 10 years of stable profits, high returns on capital, capable management, and a margin of safety in the purchase price. Use this framework to analyze companies. Only invest if the company passes most criteria and price is favorable. Buffett's hidden rules are simple. Don't overtrade, preserve capital, and keep cash available to seize opportunities. Common mistakes: chasing hot stocks, using leverage, ignoring fees, reacting emotionally, and failing to keep learning. Limit trades, assess risks carefully, and keep a cash buffer. And to recap, Buffett's 5-step plan: start early and let compounding work. Invest in what you understand. Think long-term and ignore short-term noise. Use value investing with margin of safety, keep costs low and avoid debt. Keep learning, stay patient, and remain humble. If you got value from this video, like it and subscribe. This channel gives you proven, real investing wisdom. Drop in the comments which company you will analyze first, using Buffett's checklist. I'll review a few in upcoming videos. Stay consistent, stay curious, and stay patient. That is how real wealth is built.